Welcome back, everybody. So again, we just went over simple interest up here, and we also went over compound interest. Now, I do want you to look at the numbers, compare them completely. So the table were actually identical, except for one key factor was you had an extra column. So let's go ahead and look what happened and what the difference was. So for example, if for my first one, I had $15,000 investment, for my interest, I only got $3,840, right? So my total was 18, okay? But if I were to compare that to this one, right, the same exact problem, except now it's compounded 4 times a year. I noticed that my increase was, instead of 18,000, is now 19,000. So I actually gained $4,000 instead of instead of $3,800. Isn't that cool? So obviously you definitely want to choose compound interest over simple interest any day. Now, another thing that's also a key factor is, for example, in my simple interest for this equation here, for my $4,521, my interest was $27.69. When compared to my actual compounded one, mine was only $27.61. So here I had a difference of 8 cents. So it really depends on what you're really looking for. The main key factor is, what is your interest rate, okay? And how long are you actually going to be dealing with this interest rate for, okay? So again, this is only for a short amount of period. So again, and this was compounded twice. So again, just looking at compare and contrast, you generally would more likely use the compound interest for future things, okay? So again, depending on which benefits you better, this is what you can do to help you understand whether to make an executive decision to buy bank bonds or dump into a savings, whatever it is, you can actually calculate it right here. Okay? So the next example I want to go over is going to be a bank loan here. Okay, from this example 3. Okay, whoa, I didn't. Okay, I'm gonna get rid of that. Okay, so again, so journalize the bank loan from example 3. All right. This bank loan was made on June 1st of 2020. Monthly payments are variable and due every first of the month. Okay. There are no hidden fees or 0% annual APR. Okay, you don't get any relief. Okay, meaning that this bank loan is effective immediately. So meaning that you need to pay back as soon as the first month is over. Okay. So let's go ahead and look at our problem 3 real quick. So here, you were approved for a bank loan for $5,500. Okay. So in this case, we want to look at this number. We know that it is 6.25%, and here we know that it's going to be 5 for 5 years, and it's going to be charged every month. Typically, that is the same thing for most bank loans in general. Credit cards are the same way as too. You're going to get charged interest every single month. So I think that's where the Rule 22 comes into play, because you're getting you're gonna get hit interest twice for every 12 months. So you're going to accumulate your interest a lot quicker. So here, let's go ahead and apply that concept so we know how much our bank loan is going to be for. So let's go ahead and take it one step at a time. So here let's journalize the first thing. So on June 1st of 2020, we just received the bank loan, okay? So let's go ahead and journalize this. So what do we need to write here?
The date.
We need to put the date. So the date is
1 June.
yes. First, I'm gonna do numbers. So 1, okay. So here I received a bank loan. So what is that to me?
Income.
Liability.
Yes. Okay. Okay. It is a liability. Okay. So I have a bank loan payable. Okay, as in I need to pay this month. Okay. In this case, I wasn't specific on what you bought, so I'm gonna assume that I received cash. I received this $5,000 $5,500 cash. Okay. So I'm gonna report 5,500. Okay. Now, generally, when does interest accumulate?
End of the month.
At the end of the month. Okay, so I just received this loan. Am I going to be recording interest?
Yes.
Why?
Because you got it in June. The next month's July.
Right,
Interest.
right. But I'm talking about the minute I record it, do I need to record interest?
No, not yet.
No,
No, you
not till
haven't
the
accumulated
end
it
of the month.
yet.
Okay, whoa, too many people talked at once. Go ahead. What was it?
You haven't
Until the end of the
accumulated.
month.
Nothing right now.
Yes, you haven't accrued anything right now. You just got the bank loan. They can't just charge you right now. I mean, you can't just charge you the interest right there. You haven't even accrued any days on it yet. You just got it today. So, no, you don't need to record the interest on top of that. So, good. So, there you go. Here, I recorded that I just opened up my bank, and this is my amount. Okay? So, when July 1st rolls around, I'm going to make a $200 payment, okay? Now, we need to calculate the interest that's been accrued for that very first month. And how do we do that? We're going to be using this beautiful equation right here, okay? You're going to, you're going to calculate how much interest that you're going to be accumulating every single time. Okay, so let's go ahead and make a record of here. I'm going to go ahead write month here. I'm going to go ahead and write in interest. All right, and I'm going to go ahead and write monthly interest. And then I'm going to write, okay, so let's go ahead and solve for his. So this is for the month of June, right? So we're going to accrue the month of June's interest right now. So again, how do you solve for interest?
The principal plus
Yes, so it is, yes, principal, no, it's going to be your future value minus your principal. So therefore, we need to go back a step and solve for the future value. Okay, so how much was my future value? Well, how much am I going to calculate? What is my total amount with this assumption? Okay, so I know that if I started off with my amount as 5,500, right? My rate is 6.25%. I'm getting compounded every month, and it's for 5 years. Okay, so my loan is for 5 years.
yes.
Okay, so how do I calculate it? What's the formula here? What's my principal?
Um,
What's my principal?
The principal's 5,500.
5,500. I'm going to multiply.
Six, your interest rate is 6.25.
Okay, but what do I need? What do I need to do before that?
Oh,
One
1
plus
plus
oh, right, one.
parentheses.
parentheses, because yeah, what you're thinking right now is simple interest.
Right.
0.0625.
0.0265. Where'd you get that?
That's my rate. That's my my interest rate. 6.25%.
65, right.
All right. What am I dividing it
So
by?
it's 0.
No. How many times am I getting compounded?
Monthly.
12,
12. Yes.
12 times.
Yes, 12
in a
times.
year, 12.
Yes. Okay. And how many and how long is my bank loan for? What's my time?
5 years.
Yes. Yes, 5
5
years.
years?
Okay. So once I've done that, I'm going to get a total of this amount right here, which we've already solved from above. Now, I'm going to go ahead and make that like this. Okay. So I'm going to actually create another column right here. And I'm going to do principal. Okay. So if my principal was this much, right? Okay. So this is my new future value. Okay. And then my new interest is going to be 75011.51 minus my 500. So my total interest for the year is going to be the total of 5 years is going to be 2011.51. Okay? Now, I want that to be calculated as a monthly amount. How am I going to calculate that?
Divide that by 12.
All right, but how many years do I have to pay this bill?
Oh, you have
5.
5 years.
5 years.
5 years. So what is 5 times 12? What is 60 months? So I have 60 months to pay this entire thing. So for my first month, my interest is going to be $33 and 56, yeah, oopsies, 53 cents. So let me go ahead and change that. Yes. So that is my monthly interest for this month. Is that it's going to be for the total of that much. So let me go ahead and make this all decimals, okay? So again, my total interest for the 5 years is going to be $2,011.51. Now I need to take this amount and I need to divide it by the number of payments I have. If I need to pay every month for 5 years, that means I need to pay I have 60 payments underneath my belt.
Yes.
So therefore, this month, my interest that I'm going to be calculating is going to be $33.53. So then this becomes your new principal for July. Okay, so now that means I started off with 5,500, and I'm gonna add my interest, which was for $33.53. So now my new total balance for that loan is $5,533.53. Okay, so in your July statement, you should show this amount. Okay, that your value has increased due to the interest because you didn't pay it off yet. Okay.
Okay.
So by understanding this, all right, let's go ahead and fill out our table. Okay, so our table is if I paid for January, right? So my principal is now 5,533 what was it? 553.53, right? That's my new principal, right? Okay. My interest percent is going to be 6.25%. All right. So that means my interest that I'm going to be collecting is going to be 33.53. Okay. Okay. Wait, actually, no. This is my originally I started. Yes, that's right. 53. Okay. So the month of for the month of July, this is my total amount that I get billed for. It tells me I have 6.25%, and it lets me know that my total interest was $33.53. Okay. Now, let's go ahead and journalize this payment of $200.
Okay.
Okay. So on July 1st, oopsies, July 1st, what are we paying off? What are we reducing?
Reducing our bank loan.
Yes, we are reducing our bank loan. That's correct. So here we're going to bank loan payable. Okay. All right. Now so what else are you going to be paying this with?
Accounts payable.
Cash.
You're going to pay this with cash. You can never pay, no, you cannot owe money when you already owe money. So you are going to pay, yes, cash. Okay. What else do you need to also include?
Interest.
Interest payable. Yes, you need to calculate the interest. Okay, hold on. No. It's not interest payable. You're not owing interest. What you're actually paying towards it. So we call that what?
You're paying towards your interest?
You're paying towards your interest as of right now. If you're making a payment of $200, you're actually paying your interest right now. You're not owing interest. So interest is correct. Okay? Right?
It's not you said it's not interest payable?
It's not a payable because we're not owing the interest.
paying it.
We're paying it.
An expense?
It is an expense. Oh my gosh. Okay, good. Expense, good. Okay? So in
I
total,
hope you know I didn't know that. I guessed.
that's fine, but you got it right, okay? Good. We're paying it now. We're not going to wait till later to pay the interest now. We're paying it right now. Every time we write a check and paying our bill, we're automatically paying our interest, okay? And usually, if you understand how the loans work, the first thing you're going to do is you're going to pay off your interest first. And then for whatever amount that you write for is going to actually be applied to the actual principal of the loan. So understanding that we made a payment of $200, right, for the month of July, we made a payment of $200, okay? How much of it actually is going to the loan?
Bless you.
Okay.
200 minus 33.
Right.
166.47?
166.
66.47.
Right.
Excuse me. Whoa.
Bless you.
So, your payment of $200, right, includes your payment to interest, which we found out is $33.53. On top of that, you're paying your principal back lower. Okay? You're not paying the full $200 towards your actual to your actual loan. You're only paying $166.47. And this is why credit card companies, and this is why let me think of other bank loans. This is student loans. Any type of loan that you pay off every single month. This is why they tell you, don't open a credit card, don't open a bank loan, because you're going to be spending the rest of your life paying towards the interest. And this is exactly how we see it. So this applies in real life, because the next time that you make a decision to open up a bank, understand how much the percentage interest is going to be. And if you're going to utilize all 60 months to pay off that loan, again, we just calculated that in total, you paid a total of $7,000 and $7,511. You paid $2,000 to interest.
Wow.
Yes, not even towards the actual amount that you originally owed. Okay, so that's why you need to understand that every time you make a bill payment, the first thing that's going to be paid off is your interest. Okay, so there you go. Good. All right, so I paid a total of $200. Okay, so now I'm going to go ahead and go back into my worksheet, and I'm going to recognize that my new balance is no longer 553.53 anymore. My new balance is going to be 5533.53 minus the $200. Okay, so now my new amount that I owe now is now $200 less. Okay, and if you understand how bank loans work, this is going to be your new principal. Okay, so let's go ahead and recalculate what our interest is going to be like now. Okay, so now we have a new principal. Okay, we're going to multiply that by 1 plus our rate, which is what?
6.25.
Yes. And we're going to divide that by 12. And then was that 12? And then how many years is this loan? 5. Okay. And flipping nutters. I must have hit something and I don't know what it was.
Oh, you forgot to put parentheses after between the plus sign and the 1.
Yes, I did. Thank you. I thought I hit that number. That's weird. Okay, so yes. Okay, so now my new interest is going to be for 7,284, and then now I can take this number 728416, and I'm going to minus my new principal, which is 53353. And now my new interest is 1,950. And how do I find out how many that is over the existing life of payments? So I take this number,
Divide that by 60.
divide this by 60. So that means now my interest is going to be lower. It's going to be $32.51. So therefore, my new amount is going to be my new amount for August is going to be, my bill statement should be equal to this plus $32.51. And now my new bill statement is going to be $53.6604. Okay. So every time you're dealing with a credit card or a bank loan, okay, you are going to be readjusted for every single payment that you do. You're going to get recalculated for the interest every single time, okay? If you just left this alone, then your total amount of if you say, I'm going to pay you at the end of 5 years.
Yeah.
If you say you're going to make one payment at the end of 5 years, then your total amount that you need to pay is going to be for the 7,511. But because you choose to pay back less and less and less, so then every time the interest is accruing, you could pay before the 60 months, right? You could end up paying less than what you originally then instead of the 7,500 or the total of 2,000 interest, you can pay off the loan as quick as you can so you don't ever reach that $2,000 interest. And this is exactly what gets people all the time. People say, oh yes, I can do it. I can pay before, so I don't have to accrue so much interest and pay $2,000 of interest. That's half my loan right there. Why do I need to pay? Why do I need to pay an additional, 50% of my loan towards interest? So people think I can pay it. I can pay it, but in real life, we have exactly, we have emergencies. Our money needs to go somewhere else. We got grandbabies, we got birthdays, we have to, your house is flooded. Emergencies happen all the time. Okay. So making that assumption that you're going to be able to pay this off right away is actually not true. So here again, we're going to recalculate. We're going to add this into our box again. So 536604. So my new principal is 536604 for the same amount, 6.2%. And my interest is now $32 and is it 51 cents?
Yes, 51 cents.
Yes, 32.51. Good. 32.51. Oopsies, I put 61. 51. Okay. So now because I made a payment and I paid more than my minimum payment, therefore it reduced my interest rate or the amount of interest I owe. Okay. But now I made a payment on August for $250. Let's go ahead and see how much of that actually is taken off from our actual account. So again, on August 1st, I made a payment to my bank loan. So here I do bank loan, bank loan payable, interest expense, and I paid in cash. Okay. So if I know that I paid a total of $250, okay, and my interest was $32.51. So $32.51, and I paid $250. How much of that is actually going into my actual bank loan?
Well, let's see,
217.49.
250 minus.
Yeah, 217.49.
49. Yes, so you're still paying your interest off and you're still only paying $200 off of your actual principal. So, all right, let's go ahead and finish the last month off. So now that we paid the amount, so whatever 536604 is, 536604 is, subtract the 250. Now your new principal is, oopsies, I didn't mean to do that. So now your new principal is going to be 5,011.1604. All right. So let's recalculate that again. So it's principal times 1 plus my parentheses.
0.0625 divided by that by 12.
Yes.
Parentheses, double parentheses, caret, parentheses, it'd be 12 divided by
Not divide. Not divide. You're gonna multiply by 5. Which
By
yes,
5?
yes, you can if you've already 12 times 5 already, you can go ahead and type 60. But in this case, let's just keep our components the same. So n times time. So n is 12 and time is 5. Okay, and we should get a new total of this. So what is my interest now? Okay.
Yeah.
All right. And then again,
Okay.
we're going to divide this by the total number of payments, which is 60. So now my interest has decreased even more to $31.18. So no matter how much you keep paying and paying and paying, this doesn't drop very drastically. It drops very, 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 very slow. Okay? So $31.18. So a new principal should be this amount. Okay? So 5147.22. Okay? So 5147.22, 6.25%. And my total interest was 31.18, was it? I don't think so. Yes, 31.18. Okay? So this time we made a payment for $300 for the month of September. Let's go ahead and recognize that. So September 1st, we made a payment to what?
Bank loan,
Bank loan payment.
Mhm.
interest expense.
Interest expense. And we pay this off in cash. Yes. So how much was my interest again?
18.
And I made a payment of $300. So how much of my 300 actually went to my actual loan?
268.82.
268.82.
268.82.
82.
Perfect. Okay. So this is a real life scenario if you do plan on making any loans. So again, if you are going to start your own business, first thing you're going to do is you're going to apply for a business bank loan. Okay. So this can maximize your amount that you can do with your business, right? And this is the price that you're going to have to pay. All right. And understanding that every time you change your principal, you're going to recalculate the same interest over it and calculate a new interest every single month. And every time you make a payment towards it, the first thing you're going to do is you're going to make a payment to your interest. Okay. That is number one. And then whatever's remaining actually goes into your actual principal loan. Exactly. Okay.
Do you have a choice to, when you make the payment, to go with interest or loan?
From what I've heard, yes, you can do that if you're talking to a bank. Now, if you're talking to a lender,
Yeah.
you think they're going to let you do that?
No.
No. Banks are a lot more generous when it comes to that. Especially if you are making more than one payment, right? Since this, you want to make sure that if you pay multiple times, let's say I pay to this loan twice a month, right? The first one you're gonna pay towards the interest. Second one, no, you pay towards the actual principal. Reason being is because this one in this scenario, you're only getting charged every month. I think with the bank loans, like if you were to actually apply for one, you get charged every day, if I'm not mistaken.
Okay.
So every day it's outstanding, you accrue a little bit of interest. So it could be 50 cents a day.
Oh, if it's outstanding, okay.
Yes, as in you still owe them. Then yes, you I think for house loans, it's every day. So you want to be very careful, even though for example, if I paid my credit card, now my credit card, right? If I paid the minimum, I covered just the interest, right? And if I make a second payment to it, I've already covered the interest. Now I'm actually paying the credit card off. Okay?
Okay.
So, yes.
So
All
in
right.
other words, in the long run, don't take a loan out.
I mean, if it honestly, again, yes, if you really need it for your business, then you will take it. But that's the price of what happens when you borrow money, okay?